Imagine you're buying a house. You wouldn't pay just any price, right? You'd carefully consider its size, location, condition, and compare it to similar houses. That's what valuation is all about, figuring out what something is truly worth. In the world of finance, we do this for companies and their stock. Stock valuation focuses on determining the fair value of a single share. Enterprise valuation, on the other hand, assesses the worth of the entire business. It's like looking at the value of the whole house versus the price of a single brick. Both are important for making informed investment decisions. Think of it like this. You want to buy a piece of your favorite apple pie. The stock valuation would tell you how much one slice is worth. The enterprise valuation would tell you the value of the whole pie. Understanding these values helps you make smart choices. You can see if a stock is overpriced or a bargain. You can decide if a company is a good investment. Valuation gives you the power to make informed financial decisions. One of the simplest ways to value a company is by using the price-to-earnings (PE) ratio. This tells you how much investors are willing to pay for every dollar of a company's earnings. It's like comparing the price of an apple to the amount of juice you can squeeze from it. The formula is simple. PE ratio equals price per share divided by earnings per share, EPS. Let's take Apple Inc. as an example. If Apple's share price is $170 and its EPS is $5, the PE ratio would be 34. This means investors are willing to pay $34 for every $1 of Apple's earnings. A high PE ratio could mean investors are optimistic about the company's future growth. A low PE ratio might indicate that the company is undervalued or considered less risky. But remember, the PE ratio is just one piece of the puzzle. It's important to consider other factors like industry trends and a company's financial health before making any investment decisions. Using the PE ratio alone is like judging an apple pie by its crust alone. You need to taste the filling too. While the PE ratio gives us a snapshot of the present, the discounted cash flow (DCF) model helps us peek into the future. This method estimates the value of a company based on its expected future cash flows. Imagine you're buying a machine that will print money for you. You wouldn't pay more than the total amount of money you expect it to generate, right? The DCF model works similarly. The formula can seem a bit complex, but the basic idea is this. DCF equals cash flow divided by 1 plus the discount rate raised to the power of the number of years. The discount rate accounts for the time value of money, the idea that money today is worth more than the same amount in the future. Let's say TechCo, a hypothetical company, is projected to generate $100 million in cash flow next year. Using a discount rate of 10%, the present value of that cash flow is about $91 million. We repeat this process for all future cash flows and add them up to arrive at the company's intrinsic value. The DCF model is a powerful tool, but it's not a crystal ball. Its accuracy depends heavily on our assumptions about future cash flows and discount rates. Remember how we talked about valuing the whole apple pie? That's what enterprise value, EV, is all about. It represents the total value of a business, including both its equity and debt. Think of it this way. If you wanted to buy a bakery, you wouldn't just look at the price of its stock. You'd also consider any outstanding loans or debt it has. That's because you'd be responsible for those obligations as the new owner. To calculate EV, we use the following formula. EV equals market capitalization plus total debt minus cash and cash equivalents. Let's take Tesla Inc. as an example. If Tesla's market cap is $600 billion, its debt is $50 billion, and it has $20 billion in cash, its EV would be $630 billion. EV gives us a more complete picture of a company's value compared to just looking at its stock price or market capitalization. It tells us how much it would cost to acquire the entire business, making it a key metric for mergers and acquisitions. Section 5. Comparing apples to oranges EV/EBITDA multiple. Sometimes, we need a way to compare companies in different industries or with different capital structures. That's where the EV/EBITDA multiple comes in. This ratio tells us how many times a company's earnings, before interest, taxes, depreciation, and amortization, are valued by the market. Think of it like comparing the value of an apple orchard to an orange grove. You can't just compare the number of fruits. You need a common measure to assess their profitability. The formula is straightforward. EV/EBITDA equals enterprise value divided by EBITDA. Let's stick with Tesla Inc. If Tesla's EV is $630 billion and its EBITDA is $60 billion, its EV/EBITDA ratio would be 10.5. A higher EV/EBITDA ratio might suggest the company is expensive relative to its earnings, while a lower ratio might indicate undervaluation. However, it's crucial to compare companies within the same industry because different sectors have different average multiples. Section 6. Sizing up the competition relative valuation. Imagine you're buying a used car. You wouldn't just look at one car in isolation, would you? You'd compare it to similar cars on the market to see if the price is fair. That's the essence of relative valuation, comparing a company's value to its peers or the overall market. We can use various metrics for relative valuation, such as PE ratios, EV/EBITDA multiples, and price-to-book ratios. By comparing these metrics across similar companies, we can identify potential investment opportunities. For example, if a tech company has a significantly lower PE ratio than its industry average, it might be undervalued. Conversely, a company with an unusually high EV/EBITDA multiple could be overvalued. Remember, relative valuation is all about making comparisons. It's like looking at a map of the stock market and seeing which areas are hot and which are cold. Section 7. Why valuation matters for everyone. Valuation isn't just for Wall Street analysts. It's crucial for everyone, from seasoned investors to startups seeking funding. Understanding valuation empowers you to make informed financial decisions. Investors use valuation to identify attractive investment opportunities. Companies use it to determine their own worth, make strategic decisions, and secure funding. Startups rely on valuation to attract investors and negotiate fair deals. Think of it like knowing the value of your own home. This knowledge gives you negotiating power when selling and helps you make informed decisions about renovations or refinancing. Whether you're buying stocks, running a business, or simply managing your personal finances, understanding valuation is essential for financial success. Section 8. The art and science of valuation. Understanding the limitations. While valuation provides valuable insights, it's important to remember that it's not an exact science. It's an art as much as it is a science, relying on assumptions and judgments. Valuation models are based on historical data and future projections, both of which can be uncertain. Market sentiment, economic conditions, and unforeseen events can all impact a company's value. Think of valuation as a weather forecast. It can provide valuable guidance, but it's not a guarantee. Unexpected storms or sunny days can always occur. It's crucial to be aware of these limitations and avoid relying solely on valuation metrics. Always consider other factors, such as management quality, competitive landscape, and industry trends, to make well-rounded investment decisions. Section 9. The bottom line. Making sense of value. Valuation is like learning a new language. It opens up a world of possibilities in the financial realm. By understanding the basics of stock and enterprise valuation, you can make more informed decisions about your investments, your business, and your financial future. Remember, it's not about predicting the future. It's about understanding the present and making educated guesses about what lies ahead. Just like you wouldn't buy a house without a proper inspection, don't invest in a company without understanding its value. As you delve deeper into the world of finance, keep learning and exploring different valuation methods. Remember to be critical, ask questions, and always do your own research.